I'm with Ian Talbot with the People's Mortgage. He's one of our preferred vendors of a list of vendors, loan agents that we use to write our loans.
Yeah.
We usually have some clients that come in pre-qualified, some that, they say, who do you know? And we'll refer them to someone that we trust and go from there. So anyway, this is kind of the second part of a series I'm working on for my new home buyers, because after they get the offer, it's like, what's next? And so I'm trying to get ahead of it by saying, okay, these are the next steps. The first video I did, I covered that, okay, we got our offer accepted. First thing you got to do is, according to the real estate purchase contract, is get your earnest money in within 4 days of acceptance. Then after that is your due diligence, and whether you want to do it yourself and hire a home inspector. And then after that, the next date that we have to keep an eye on is our finance and appraisal deadline. But to back up a little bit, before they ever get to me, they come see you to get pre-qualified. Correct. So maybe you can briefly tell us what that process is, just to refresh. What's that take from someone that comes in your office and says, okay, I want to buy a house, let's get pre-qualified.
Yeah, happy to cover that. And you're right on the money there, that getting pre-qualified or pre-approved before even shopping and making an offer is really in your best interest. I kind of compare it to a race. You want to do a race, you decided you want to do a race. Well, you don't just go out and do the race. You have to plan ahead and prepare and exercise and do whatever it takes to get ready for the race. And getting pre-approved for a loan is like that preparation. Mm-hmm. So somebody comes to me and says they want to buy a house, which is great. That's what we do. We help them buy a home. And what we want to do is talk to them about their plans, their goals, get an idea of what they're trying to accomplish, and really what they want to qualify for. Mm-hmm. And then we really pre-underwrite a loan. And that means we have them fill out a mortgage application. That can be done in person or online. We have them gather up all the necessary documentation to verify and prove their income, their assets. We pull credit report to look at their credit score and their credit history. We really scrutinize the financial situation the same way that an underwriter would, and come out on the other side telling them, yes, you're pre-approved for X dollar amount. They then get to decide whether they even want to spend that much, but my job is to tell you what you can spend. Your job is to decide how much you're comfortable
then how
spending.
much they qualify for versus what they're comfortable with the payment.
Correct, yeah.
We get that all the time.
Just because we say you can spend the money doesn't mean you have to spend that
right.
money. It's really up to you guys to decide, or the buyer to decide. So doing that, though, gives you an extremely high confidence level that once you do go shopping and you found that house, you can make an offer with confidence that you're eligible for that purchase. And we'll include a pre-approval letter that you'll include with your offers. Mm-hmm. That lends strength to your offers. A seller that sees a pre-approval letter knows that you've done your homework and your research and that you are actually ready to buy. And so that benefits you in the buying process as well. It also allows us to address potential concerns or hiccups that you may not even be aware of in your credit or your financial situation.
Because sometimes we've had clients that we've had to do some homework.
Yeah.
We've had to get some things cleaned up, and even in my case, but we got it done. We had Amber and Elliot. We worked on them for over a year.
Yeah. Sometimes there are a lot of hurdles to overcome, and truthfully, you could be an extremely responsible person with your finances and still find that there are errors, mistakes, or omissions on your credit report. I've even heard that statistically up to 60% of credit reports have mistakes on them. And if you haven't pulled your report in some time, pulling it as part of our process will give you the chance to review the accuracy of that information and correct anything that we come across. Now, we're not a credit repair agency, so we have some great referral sources that we can send you to help take care of that. But really, it's just giving you a chance to look at your financial situation before you've gone through the process of getting under contract. Because once you get under contract, going back to that race analogy, once your offer is accepted, you're under contract, that's like the gun going off. That's the trigger of the race to begin, and the time to prepare has passed. And if you're starting that process without having been pre-approved before, you've now compounded the stress of you now only have so much time, just like a race, you only have so much time to get it done, but you're having to both work on pre-approval and getting through the loan process at the same time. And so it's so much smoother, so much less stress and headache if you go through the pre-approval process first and then go shopping. It saves everybody time, energy, and some stress in the process.
And a lot of the agents out there that are listing their homes, it says right in the MLS listing that you need either proof of funds and your pre-qual letter to even submit the offer. They're not going to look at it.
Yeah.
So when you submit that pre-qual letter, how confident are you that, and barring they go out and, you know, fund a car or something, that you're going to get them to the finish line after you've looked at it, you gave them the pre-qual? How strong is that? I mean, you're not just writing these out like Monopoly money.
Yeah, no, this is, as I mentioned, it's a high confidence level. It's nothing in life is a sure thing. There can be some unknowns pop up in the process. We try to be as detailed as possible in the pre-approval stage of things so that doesn't happen. And it is very rare for that to occur, but occasionally it can. Sometimes there's just something we didn't know or didn't find in the process. But the way I like to say it is extremely high confidence level that when you do get under contract, as long as your financial situation is the same or close to what it was when we pre-approved you, then you should be confident we can get you a loan at that time. And so you want to avoid, as mentioned, opening any new lines of debt or missing payments on current debt, because that will in fact impact your credit scores dramatically. You want to make sure that you still have the same or more assets available for down payment purposes and closing costs, or you know where that's going to come from through the plan that we created.
So getting back to the conventional loan, once you're writing them up on the conventional loan, you verify that they have the funds to come make the difference up before the offer is submitted. Yeah,
and in today's market, rather uniquely, we also address, okay, let's say you're making an offer for $350, you have enough money to put the 5, 10, 15, 20% down. Do you have any other funds that you might be willing to use towards this purchase? Because so many homes are entering bidding wars where having excess funds above and beyond purchase price may be needed in order to get your offer accepted. Now, that's not to say it's necessary or mandatory. It's not, but it certainly makes your offer look more appealing to the seller.
Okay.
And on the topic of those funds can't come from just anywhere. As part of the pre-approval process, we have to source where those funds originated from. Lending guidelines today are very different than they were 10, 15 years ago, where they didn't really care about your income as much or your assets and the source of where those funds came from. Today, it's rather detailed, and we have to determine exactly where they originated and whether that's an acceptable source.
I remember bringing in statements from my savings account to close on ours. So.
Yeah, and it has to even be documented correctly. It can't even be just a simple computer print off of your bank account. It needs to be the official bank statements provided by your bank or credit union every month.
Okay, so I want to bring this back where we were.
Yeah.
The first process was, before my first video, was they got with you and they got pre-qualified. Now our offer is accepted. They were doing their due diligence. Once we get past that due diligence deadline, you're working the whole time. Once we get the offer accepted, I send you a copy of the contract and you start to work on it. Fill in the gap. What's happening between that time? Is there anything different or more between there and settlement deadline?
Yeah, so we are working from day one. As soon as we receive the contract from you or the client, that's again, the gun has gone off, the race has begun. So we start working concurrently, even if you are going out and doing your due diligence, and as you mentioned in your video, having the home inspected and other things. You know, maybe you find something that you don't like and you withdraw from the purchase. We're still making progress regardless of whether that's going to happen or not, because we need to use up every bit of time and be ready to close as early as possible. So when you give me a contract, the first thing that I do is going to review the contract for all details, making sure I'm aware of purchase price, location, property type, any historical information about the property I need to know, and very importantly, the financing and appraisal deadline date and the settlement date. I'll contact the borrower and go through those details with them to make sure that we still have the loan structured the way that they want it structured. You know, sometimes they change their mind on how much down payment they want to put or something like that. We talk about rate, and then we begin the loan by having me generate the initial disclosure documents. And these are very similar to the final closing documents, but they're sent out on day one rather than the final day when we close the loan. These disclosure documents can most of the time all be signed electronically, so they're sent to you via email. And they'll outline a loan estimate which details the estimated closing costs on your loan. I say estimated because some of the fees are not solidified on day one. They're oftentimes determined a little later in the process. So on day one, it's best guess. So I encourage borrowers, don't take these for solid fact. Things will probably change a little bit as we move ahead. They'll also, through the course of 20, 30, 40 pages, outline all of your rights as a borrower. They'll detail out to you what's going to happen as we move forward. And they just require initial signatures. For the most part, these are non-binding. So when you sign them, out of all of those pages, you're basically saying, I do want to proceed with underwriting, but I understand that things may change. And they may change from our end, but they could also change from the borrower's end. They're free to adjust things, their down payment or the rate as we proceed. And so we keep that line of communication open. We can't submit to the underwriter until those disclosures are signed. So that's important to get that done as soon as possible. We also ask for additional or updated documentation at that time so that we're prepared to submit to the underwriter.
How important is it that the buyer gets those documents that you request to you?
Yeah, time is of the essence here. Again, it's kind of a race. Most contracts we get a 30-day turn time on. Our goal is to be ready to close as early in that 30-day window as possible. We have standard turn times in underwriting and appraisal that we can't change a lot of, but the most control over the process is you, the borrower. It's you getting those documents requested back to you as quickly as possible. Because oftentimes once we send that request, we are then just waiting. There's not much we can do until those documents come back. So whether it's a day or a week, that's how much time we may lose in the process when asking for those updated documentation. The frustration some borrowers come back with is, well, you've already asked for that. I've already given you that. And occasionally, we may have received something and not recognized it. But what's more often is we're not asking for the same document again. We're asking for the updated version of it. And that's because anytime a new bank statement comes out or a new pay stub is released, the old one is treated as an expired document, and we now need the most up-to-date. That makes sense. And when we close on the loan, some of those documents can only be so many days or weeks old, or we have to update them even again. So getting those documents to us and electronically signing your disclosure documents are the first step in the process of getting your file to the underwriter. Once you've done that, we submit everything to the underwriter to review. And if we've done our work properly, then the underwriter is going to look at things very similar to how we already did in the pre-approval process. And they essentially just have a checklist. Do we have income documents, and is it enough? Check. Do we have enough assets, and is it enough? Check, yes. And they'll go through their checklist. And that can take anywhere from a few hours to a few days, depending on the industry. Right now, things are happening very fast. We have some investors that are underwriting the same day, while we have a few others that can take a couple of days. And so we want to, again, make sure that's going into them as soon as and as early as possible. But what they'll do is, after they've reviewed everything we've given them, they'll come back with what's known as a conditional approval. They say, okay, these guys are approved for the loan, but we have these few remaining conditions that can also be known as questions that need to be answered before we can actually close. And that usually includes your appraisal. And we have to order that appraisal as early as we can, because despite these appraisers in the market doing an amazing job, they are overwhelmed. And as you probably experienced, appraisal turn times are being stretched even further. When it's slow, it's easy to get an appraisal in 5 to 7 days. Right now we're being quoted 2 to 3 weeks, and that's a big portion of a 30-day closing timeline that can be eaten up without us having any control over that. We have requested rushes at times, which can be an additional fee, and we would discuss that with any client as an option. But really getting that ordered as early as possible is the best way to manage time as well. So we are working on a couple of things concurrently. That's getting the appraisal ordered and getting the file to the underwriter and those conditions cleared. The financing and appraisal deadline is the point in the process where your earnest money goes hard. And by hard, it means it's non-recoverable.
Mm-hmm.
So if we extend this process beyond that financing and appraisal deadline date, well, if for some reason the borrower isn't eligible for the loan after that day, you unfortunately would not be able to get your earnest money back. And we do not like risking people's earnest money. So we avoid that at all costs and make sure that we get everything done that needs to be done by that date, and that we're comfortable with going beyond it. So.
And the big goal is to get the clear to close.
Clear to close. Those are words from heaven.
Yeah.
Everybody in the industry
Offer
knows
accepted and clear to close. Those two right together.
Yeah. To get clear to close means that the underwriting is done. You are essentially qualified for the loan and signed off on by the underwriter, and we can then move to close.
Okay.
It doesn't mean you can close that same day. There are a series of disclosure documents that go out even after the initial disclosure document, and that's updated loan estimates, and eventually it's your initial closing disclosure. They can all be electronically signed, but when the initial closing disclosure goes out, that triggers a mandatory 3-day waiting period before we can close on the loan. And so we try to get you to clear to close as soon as we can so that the CD can be issued. And once you get that, CD is your closing disclosure.
Okay.
And once that's electronically signed, we then know that we could close 3 days or later from that point on. And it's really exciting to get to clear to close. We love seeing borrowers happy and ready to move into their home. It takes an army to get you there, but we prefer the duck approach, if you've heard of that.
Yeah.
A duck on water doesn't look like it's doing very much, but underwater the legs are scurrying around, moving really fast. And if you've ended feeling like, well, that wasn't very hard, we've done our job well, and that's our goal every time, is to make sure this is as smooth a process that happens as quickly as possible. And a little bit of work ahead of time in the pre-approval will make all the difference in the end as we get you under contract and close on the loan.
Nice. That should be pretty clear. So, thanks.